All right, the purpose of this quick webinar is to look at if our stock market today, as of August 24th, 2013, are we in a bubble, or are we in a correction, or are we going to continue to grow? And so we're going to take a look at our chart, our S&P chart. Remember, the S&P is an index of 500 companies, so it's one of the broader stock market measures for the U.S. market, and we'll take a look and run through some of the charts. All right, so here's the last 6 months of the calendar year. We're going back to March into August, and you could kind of look here at the S&P. The general trend of the S&P here is kind of a upward moving line. So if I were to kind of come in here and draw a trend line, and I'm going to kind of run it through the lows of the market. So there's one trend line. And you can kind of see that this is an upward moving line. So we've been in a bull market for sure in the last 6 months. If I go back to the last 9 months, you can see kind of the same pattern here. We have a nice upward moving market. And you can see we had a correction here, and the market has kind of floated up to an all-time high. It went over 1700, and now we're kind of getting into correction territory here once again, and you can see the market kind of correcting itself. Now the question is the trend going to be a further correction, or are we going to continue another bull leg up here? If we go back, I'm going to go back to as far as the 60s here, and I just want you to look at the S&P. It was flat in the 60s and 70s. It had amazing growth in the 80s, and then of course we have the dot-com run-up, crash, run-up, and then we had our more recent financial collapse, and now we've had just an extreme bull market since 2009. And you can see we have broken the top old level that we had, and we kind of blew right through it, right through the top. And so let me kind of draw the top there the best I can, and you can see kind of this movement up here. We've kind of broken out of that double top. So now the question is, well, what is causing this? What is causing this market to kind of run up? The financial system collapsed. The government stimulated the economy with massive spending. We looked at a lot of tax cuts. The Social Security was cut 2 points. We have been seeing our Federal Reserve printing money, $85 billion a month with a B. And so we've kind of seen the market kind of really come back with their fury. But if we look at economic indicators right now, they're not blowing us out of the water. And since they're not blowing us out of the water, the Federal Reserve is continuing with a low interest rate policy, and also with the quantitative easing policy, the printing of money every month. So the question what the market is kind of waiting for is, when is the Fed going to pull back its quantitative easing, and is the economic data coming in bad enough to kind of warrant continuing printing? So that's kind of where we're at right now. So if we go to kind of a 1 month, you could see kind of the action here for the day. And really what's going on, there's not a lot of volume in the market, and there's not too much volatility overall. You see a lot of days where the market really is not getting too wild upswings in one day movements, and that's kind of where we're at right now. So if we go back out to we'll go back to 3 year, and you can kind of see that nice run up that we've had, some corrections along the way. Remember we had, this is when Obama was elected. Remember at the end of the year, in this period here, we had, let me kind of zoom in, this is when we had our debt ceiling debate, and you can kind of see that debt ceiling debate happened at the end of the year, and then they solved it, and then you saw that market really jump up quickly in a matter of a couple days there, and then we've been in bull territory ever since. I am kind of the opinion right now that we're kind of running out of steam here at this current point, and I think consumer spending, I just don't see the consumers spending their way out of this recession, and so therefore the government is going to continue to print. They don't even know at this point how they're going to exit. Half of the members want to exit, the other half don't want to exit of the FOMC members. And so we're kind of just in this waiting period. The market is really waiting instead of really relying and waiting on how businesses are actually doing. If we look at revenues for the past quarter, most companies missed on their revenue estimates. That means that what they said they would make in sales, they did not make. And so because of that information, it kind of worries me a little bit that they're not selling as much as they hope for. And that just shows you that consumers aren't confident enough to get out there and spend. So if the data keeps coming in poorly, that means the Fed's going to keep trying to keep the interest rates low. But if we look at the 10-year on the Treasury, the 10-year has really risen quickly in the last few months. So interest rates are starting to rise here. In an already fragile housing recovery, any rise in interest rates in a dramatic fashion could really end that rally, and then that would take a lot of steam out of our stock market. So keep an eye on the situation. It's fun. Business is fun. Following markets are fun. And you could use your knowledge that you're learning here in high school and kind of apply it to real life. Let me show you a way you could trade with this information. A good way to trade off of the S&P, right here I have the ticker symbol SPY here at the top, SPY, and it basically pretty closely mirrors that S&P 500 index. So if the S&P goes up, this ETF will go up. If it goes down, the ETF goes down. And you can see the ETF is trading currently at $166.62. So if you feel like the market is going down, you could short this ETF, and if you feel like the market is going to continue to climb, this is a great way to get the market return. And as we teach in our investing class, we don't want to put too much capital at risk at one time, so we like to use what are called options, and I'm going to pull up an option chain here. I'm not really going to describe the option chain, but by using these contracts, we could lock in large amounts of control of shares at a fraction of the price it would be to buy the stock outright. So in our investing class, we really get into trading options, understanding how to read these and how to make the trade. So as you can see, a call is when you think the underlying stock is going to go up, and a put is when you think the underlying stock is going to go down. And as we can see today, since S&P went up 0.34%, 56 a share, this underlying stock went up. You see all the calls went up in value, and you see all the puts went down in value. But when you have the market going down, you'll see the opposite effect, unless it's flat. If it's like up 0.01% or down 0.01%, you probably see both of these actually fall because of the premium. Remember, these options contracts expire, so the closer you get to the expiration date, this concept of premium will expire. And we learn all this in our investing course. But these options are a great way to control your investments with not putting up as much money. So instead of buying 100 shares at $166, where I need $16,600 to short 100 shares, I could short 100 shares for as little as $66. So that's a huge difference, putting up $16,600 versus $66. So we explain on how these work in our class, in our investing course. So look at the market, kind of come up with a guess, and then we could teach you on how to actually trade these option contracts. All right, keep watching that market, and we'll keep updating you with new videos.